So we just heard from a panel of more traditional energy companies and their views on the Canadian energy market. Now we're going to go sort of off the beaten track a little bit in the energy market and talk to fuel retailers who have a kind of a variety of businesses. So to my right is Mike McMillan, Chief Financial Officer of Parkland Fuel Corp, and Beth Summers, Executive Vice President and Chief Financial Officer of Superior Plus Corp. So I wanted to start, because you guys have relatively unique business models that may not be familiar to everybody in the audience, I wanted to start by asking you just to give a brief overview of your companies and what they do. Mike, do you want to start?
Great. Yeah, thanks for joining us today. So Parkland Fuel we think of it as Canada's largest independent distributor of fuels, and so we do about 17 billion liters annually right now, which is about 4.5 billion gallons. We distribute through 4 different channels, basically a retail channel, a commercial channel. We have a supply and distribution and wholesale channel, and we also have operations in the U.S., mostly in North Dakota, South Dakota, and sort of the Bakken and into down as far as Utah. Our strategy is pretty simple. It's organic growth and consolidation, driving the base business. We expect to do organic growth about 3 to 5% per year through a number of initiatives and consolidation. We've built a unique supply capability within the business. And so we distribute gasoline, diesel, and a number of liquids like propane and so forth. Last year we did 2 of our largest acquisitions to date. So we bought the CST Canadian assets for about $1 billion Canadian. We also bought the Burnaby refinery and the Chevron assets in Canada for about $1.7 billion, including terminals and so forth. And so that's kind of where we play. Across Canada, we have about 1,850 locations. In the retail side, 300 branches, and continue to grow and consolidate from there.
Okay, great. And Beth, do you want to give a brief overview of Superior Plus?
Yeah, Superior Plus. We're roughly a market cap of 2.2 billion, listed on the Toronto Stock Exchange. We have 2 main lines of business. One is our energy distribution business, which is propane distribution, both across Canada and down currently through the east coast of the U.S. We also have a specialty chemicals business. It is 2 primary products, one being chlorate, which is a chemical used by pulp and paper industry. Your paper's white because chlorate bleaches it. And then we also have some chlor-alkali products. From a market share perspective, across Canada, we are coast to coast on the propane distribution side, roughly 40 to 45% in that range of the market share of the Canadian market. With our latest expansion, we have been looking at acquisitions. We did an acquisition which closed in the summer across the Northeast. We bought the NGL Energy Partners propane east side there, so now we're down the west coast. From there, we're roughly sort of in that range of 5–8%, depending on those 22 states that we now cover. So from an overall strategic perspective, we target organic growth. We like to target 2% more than the industry growth rate. And then from an acquisition perspective, very much active in filling out now our footprint, mostly in the U.S., where there's a lot of growth opportunity. A lot of targets, a very fragmented market in propane distribution, and looking from that side to continue to grow.
Okay, great. So we heard from the last panel that it's been a volatile few years in the Canadian energy markets. Now, you're not necessarily directly impacted by that the way that a traditional oil and gas producer would be, of course, but there's connections. And when we spoke before, you were saying that sometimes investors lump you in with the traditional energy producers, even if that's not reasonable. So talk a little bit about how your bonds, your debt have performed over the last few years with that volatility, and then what, for the audience would separate that investment from, the debt of a traditional energy producer.
Sure.
Oh, you can go first.
Okay. Yeah, I think, and you're right, I think, broadly we're energy distribution. Mm-hmm. And I think when I think about it, our bonds, so we've been in the Canadian market for about 4 or 5 years. We've got about 1.2 billion Canadian out there, and we just entered in the U.S. market last March, and we had about a $500 million bond we placed. Our bonds have traded pretty well, and the one thing I would say is we're a bit of a diversified business, both geographically and by product. Mm-hmm. Distribution in nature. And I would say, fundamentally, I don't think there's any substitute for performance and so forth. And so we've been able to, meet our guidance targets and, at the middle or above. We've consistently, realized synergies in integrated businesses and things like that. And I would say, that's played well for us. There is a component of our business that's very resilient because it is a spread business. When we think of the retail business, it's pretty ratable. A lot of the distributed fuels that we do are pretty ratable. We have some variability in the refinery since last year, but we are benefiting from, Western Canadian priced light sweet crude and a product market in Vancouver, which is pretty robust. And so, I think all that to say, from our perspective, it's really around performance. We've been able to show consistent results, continue to grow the business, and I think fundamentally grow our base business. And that's played well. It's our bonds have been pretty stable, trading around par, and when we've gone to market, it's been pretty receptive. So quite pleased with that. Although there is a bit of an energy onus, we also have that retail side, which I think people also engage with and understand the rateability there.
Mm-hmm. Beth?
Yeah, I think from a Superior Plus perspective, there are times. I mean, it is energy. We do often get grouped with energy. I think we're a little more complicated where our businesses are very different. The specialty chemicals. I think, getting grouped with general energy in certain circumstances works to your benefit. When things are going well, it works to your detriment sometimes when they aren't. That being said, I do think certainly for those that know our name, sort of similarly, our business model where that commodity price is really a pass-through. Our EBIT on the energy distribution side is really being generated by the act of delivering that energy. So as such, it's certainly more stable in the cycles. Our revenue will go up and down, but our EBITDA will, just grow as the business grows or remain mostly stable. So I think from a performance perspective through time, I think, my view is the bonds have performed well. A little bit of I think we're going to talk a little bit later about our entry into the U.S. high yield market, which had a little bit of an impact on us as we moved into that market. But overall, I think people understand the name, and sort of similarly to your comments, as you're growing and you're performing well, I think you're rewarded for it.
Mm-hmm. Let's talk about, you've both recently done U.S. debt issuances, and in both cases it was the first time you've done that, correct?
In the U.S.
In the U.S., right. So just talk a bit about your experience with that, tapping the U.S. market for the first time and some of the challenges you encountered compared to issuances in Canada.
Sure.
Mike?
I think, again, we anticipated going into the U.S. market before we did last March. And, I think last year we were here, we even said it's not a question of if, it's when, and it ended up being in March. And I think from our perspective, we had a bit of a plan to meet some of the investors and do some non-deal sort of marketing and get our story out. I think the big challenge there is such a broad, deep market in the U.S. compared to Canada. We're well known. I think both our companies are extremely well known in Canada. And so, we've been in there on the equity side for many years and the debt side. So coming into the U.S., it was developing a bit of a presence. When we did engage and decided to do an offering, we considered liquidity as a big onus for us, just to make sure we had enough in the market to get a following and the reception. And then the marketing efforts, I would say, again, you go across the country, it's more involved. Something you might do in Canada in a couple of days. Here, it's such a broad market, you want to cover a lot of the markets, and so we enjoyed that. It's a challenging week, but I think laying a foundation ahead of time is really important for execution, and then continue to follow up. I think we've also thought about coming back to the market at some point when it's warranted, and so we see it as an opportunity to have access to capital on both sides of the border. So.
Beth, what was your experience?
Yeah, and I think a lot of the comments are similar. I think in the Canadian market, our name is so well known. I don't want to use the word that you become complacent, but you have an expectation. People know your company well, so it doesn't tend to be all that taxing when you take an issue. People understand it's a very simple process. I think as much as when we were going to the U.S. and had that consideration, as much as we'd been warned several times, it's different. It's a lot of work. It's challenging from just getting through all of the additional pieces and I'm going to say parts that you don't have to do when you're in the Canadian market. It was a lot of work. It was a challenge for the team with everything going on with the acquisition at the same time we were working on. But again, it goes to show you have to keep doing your work, doing some upfront work, and then frankly do a lot of follow-up work to make sure that more people know your name and you get the story out. I think what we found is there was, you're always going to find your benchmarks. Our benchmarks were the MLPs. our largest competitors in the U.S. And I think the one thing we didn't necessarily anticipate and quickly found out is we had to spend a lot of time educating on why we're different and how our business model is different. Some of the challenges that the MLPs are facing aren't the same challenges we're facing with our business. And one of the other key differences for us is that in our Canadian business, we're very much commercial and industrial. 70 to 80% basically commercial, industrial, and then residential is that smaller piece, which is the opposite that you typically see in the U.S.
Interesting. Okay. Mike, you said you've seen some unsolicited interest from investors. So talk a bit about that. What do you think drives that interest in your debt?
Yeah, I think it varies, but I would say, we've been in the market for a period of time, and, and our story's been getting out there, and I think, it goes back to what I said earlier about performance. And so, the feedback we get quite often is they're looking at us as a high-yield investment, but also it's like yield with quality. And so, given the rateability of our business, the performance that we've been able to put together, we've had some interest when we've done issues and otherwise just coming in. I think it's unique in the market too. I think everybody probably in the room is aware that there's been a lot of refinancing activity. There's been a lot of capital to put to work, and so we've had interest from that perspective. Just saying that if we were to do something, they would be interested, and so that gives us a great vote of confidence in terms of just as we anticipate or as we think about our strategy and what opportunities come ahead. We've had some very good support from both sides of the border, but largely in Canada.
Are you finding, you mentioned high yield, are you finding appetite for high yield is still strong? Has that shifted at all over the last little while?
It does move around, as we all know. I think, what I found this fall, the indications and stuff as we get updates from the banks, that there's a lack of supply in some markets and so forth, and so it feels pretty robust. Rates have gone up a little bit. I think that's brought others back into it, and we monitor it all the time. We keep an eye on it. I mean, we want to be able to go to the market at the right time. I always like to go to the market when we actually don't need to. If we have other forms of capacity, but we'd like to term it out. Our company is really geared around, I like certainty around the interest rate and things like that. We like to lock it in and align it with long-term asset purchases. And so, I think we look for all those factors to line up and if the market's receptive. But right now it does feel pretty receptive. And if there was a need, then that would be a good environment to be in. So.
Beth, what's your sense of the state of demand for new debt? As Mike said, there's been a lot of refis. So do you get is there a real appetite for new debt in the market right now?
Yeah, I mean, my view would be, yes, there is, when it's, depending on what the use, right? There's a difference when it's a general corporate uses and when it's tied to an acquisition. I think, from my perspective, I mean, the demand's there. I think, if you're putting it to work on acquisitions, yeah, absolutely. I mean, I think the market's great. It's just a matter of continuing to identify where you want to use the funds while it's there to put it to work.
So for both of you, when do you next expect to tap the debt market, and what would be the major driver of that decision? You mentioned acquisitions, for example. Mike, do you want to start with that?
Yeah, I can't really say timing-wise. I mean, I go back to our history. The way I think about it is, we always want to have capacity. We would go to the market, and it would be, the use of proceeds would be tied into some acquisitions. Or putting together some financing. We often do some small acquisitions, and putting something like that together may give us an opportunity to term out some of our revolver is generally the way we approach it. And so, I can't say definitively when we'd be back into the market, but it would be contingent on a transaction of size that we feel that we can put enough liquidity into the U.S. market to make it, meaningful, or in the Canadian market as well. You can do smaller placements and look for and watch the interest rates. I think for us, we've priced fairly well on our high yield bonds, and we're pretty sensitive to how that moves as well.
I was going to ask if you'd be looking at the U.S. or Canada. So it sounds like it sort of depends on the size and what kind of
and market conditions and so forth. I mean, I think we would look at both markets. I would say, depending on the size that we can put together and the requirement. Yeah.
Mm-hmm. Yeah. Beth?
Yeah, I think from our perspective, it's twofold. Obviously, as we move forward, if there's a larger acquisition that we were looking at, that would certainly have an impact on potential timing and going to the market. We also, from a strategic perspective, there's lots of smaller entities, very fragmented market, so the acquisitions tend to be very small in size. The EBITDA, on average is usually between 1 and 5 million EBITDA size. So again, part of that is doing those tuck-in acquisitions where typically for the flexibility, we'll use our credit facility. That being said, as we look to that and continue moving forward at certain points in time to ensure that we've got that cushion of liquidity that we target on an ongoing basis, that's when we'd potentially look to term out. So similarly, there isn't a definitive time frame, but opportunistically looking at the market and based on how much we're using on our credit facility, we'd look to the market.
And U.S. or Canada, would you go through that arduous process of tapping the U.S. market
Well,
again? I guess it's easier
what
the second
what
time,
I'm
right?
told is it's easier the second time, and I certainly hope so. No, I think from our perspective, similarly, I think the advantage is, depending on the size, certainly the U.S. market's very deep. Now that we're in the U.S. market, I think coming down, ensuring that our story continues to be told is very important to make sure that we can continue to identify new investors to come into our name. So from that perspective, I think the size of a particular issue, obviously, a reopening allows you to do a smaller size, but part of it is also opportunistic. What do the rates look like? You can always swap it back from a currency perspective. Mm-hmm. So it really is looking at where things sit, and there's multiple factors that we would look at to make that determination.
Out of curiosity, do you see a difference in the trading patterns, the valuation of your U.S. versus Canadian debt? Is there a significant difference in the way those two markets behave?
We haven't noticed much in terms of the valuation. Mm-hmm. They've been pretty stable. And it is one thing that we're conscious of. I mean, we're a long-term view on our company. We look at long-term assets we're investing, and so we're sort of looking for alignment there with investors. Trading activity has been, I think, certainly greater in the U.S. than Canada. There's more liquidity on this bond, but and we're learning. I would say we're also learning the U.S. market a little bit, but I haven't noticed dramatic shifts that way. We often have fund managers talk to us, and they're participating in both sides of the border as well, and so I find sort of the same dynamic for that reason.
Mm-hmm.
Yeah, I think from our perspective, there was a high proportion of our U.S. bond was taken by Canadian investors. So it's very difficult to comment on whether, from a trend perspective, we're seeing anything much different. It hasn't been very long, but I think there was a large proportion of the Canadian investors participating, which is great in a way. The one thing is through time, we certainly want to make sure that we continue to attract new investors in the U.S. again, to help as you start filling it out.
Mm-hmm, mm-hmm. Makes sense. So we talked about how you are both, not traditional energy producers, how you have factors that very much differentiate your businesses. Do you find, though, that when you have volatility in the energy market, when the price of oil, gains or falls significantly, mm-hmm. Does that still impact, I guess, both your bonds and your equity? Do you find that you can't fully, I guess, escape from that impact, even though your business is not directly connected to it the way that a traditional producer would be?
Cool. I think our equity and our bonds, I think, have traded more related to our transformation that we've gone through in the last year and a half. With the two big deals I mentioned, our equity traded down for a bit of time. We had two very large transitions to do. One with CST and Couche-Tard. One was Chevron to carve out these businesses. We had a big turnaround at the refinery, which drew some questions, and we have all the people and all the resources to do that. And so what I found was our equity traded down a little bit, our bonds moved a little bit, but probably more subject to the factors in our business. And then as we emerged, from the first half of the year with a lot of that behind us, those projects behind us, and we have one part of a transition left to do on the refinery, our equities come back fairly strongly, and our bonds have held in right around par and so forth. And so I tend to look at it, it's more subject to the factors in our business in the last year, given the sizable deals we've done in the transformation. But we are watching the markets. I know even when we went out and did our U.S. issue, there were a number of things in the markets that happened that week. Tillerson was let go, and the MLP structure changed, and we still managed to work through the deal. So we're very conscious of the macro and the broader factors that can affect it as well.
Yeah, that MLP structure change was very dramatic and unexpected when it happened, right?
It was perfect timing.
Yeah.
We still managed to get it done. But,
Beth, how about you? Do you?
I mean, I take the point. Obviously, things that occur in your business have a large influence. I think in periods of time when we've just sort of been running the business and it's been relatively stable, I mean, I think you do see it tracking, and again, sometimes it works to your benefit and sometimes to your detriment. I think in my view, I think there is some influence overall, whether it has that direct impact or not. Again, we also see some impacts when there's dramatic things that occur on the chemical side. Sometimes you see some impact. But again, you get the ups and the downs on that side. Mm-hmm. But I do think fundamentally nothing really replaces from your business delivering and growing and the rest. And if you have a business model that's different, your EBITDA should be growing regardless of what's happening. So from that perspective, I think the market sorts itself out through time. But in the short term, I think there are some influences on the ups and downs for us.
So the approval of the LNG terminal, for example, wouldn't necessarily have a major impact on your performance the way that it would on.
But it could, depending on where you're sitting and and where you're grouped and where you're being sitting in people's portfolios. Sometimes you get an impact as they sort of increase and decrease their weightings.
Right, and I guess that's coming back to the idea of being sometimes lumped in with with the traditional.
Yeah.
So we're running low on time, but I just wanted to wrap things up. I wanted to ask both of you, looking forward, what do you think the biggest opportunity and the biggest challenge facing your business is? Any part of your business, just sort of what are you most excited about? What are you most worried about? Beth, do you want to start?
Yeah, I think from the opportunity and the challenge is probably one and the same. I mean, we closed a large acquisition this year. We're on the tail end of delivering the synergies of the CanWest transaction that we did in 2016. So I think the reality is for us, we feel that the market's doing a bit of a wait and see. We'll deliver that EBITDA, we'll deliver the synergies. And so really it's us continuing to deliver, showing to the market that we can do what we say and execute, which we've done historically, which we intend to do going forward. And I think with that, then we'll demonstrate that growth and should be rewarded.
So integration, in other words.
Yes.
Yeah, okay. Mike?
Yeah, I would say our perspective is quite similar. We've put together a couple of big businesses. We've grown from, a couple billion in market cap to 5.5 now. And there's a lot of change, a lot of new culture and people involved. And so, I think for us, the integration aspect, we've built a corp dev team to do diligence. We've also deliberately built an integration capability, and I think that's critical. But, when you bring in a Chevron into our culture, that's a big change. And I think, one of the things we are very mindful of is just how we manage those transitions, how we help people adapt to change, and also deal with the opportunities. There's a lot of activity. Beth mentioned the industry, as we see it, is very fragmented on both sides of the border. So in the U.S. market, I mean, there's a lot of independent operators that we could buy and tuck in, and so bringing those pieces together effectively in Canada as well. And so I would say, the challenge for us is not the lack of opportunity. It's managing through the process and being disciplined and just helping people adapt to change. On the financial side, I think things have been pretty receptive, and again, we go back to performance. I would say sustained, ratable, and inconsistent performance is key for us to have success in the future.
One last very quick question. You've both been pretty active on the M&A side. Do you find, does that have much impact on the way that the ratings agencies view you? Beth?
It's sort of interesting in that, from a rating agency perspective, I mean, I think there's changes that occur with an acquisition. Our acquisitions have been very clearly, implementing exactly what we said we were going to do from a strategic perspective. So I don't know that it's necessarily changing the way they're looking at us. I think, as you grow in size, I think that has an influence over some of the metrics that they'll use. Clearly, as we've grown, our leverage has grown, so that has an impact. But I don't think they fundamentally look at us differently as long as we're delivering and as we have our acquisitions, they're in line with the strategy that we've communicated that they understand, and we're doing what we say we're going to do.
Mm-hmm.
Mm-hmm. Yeah, in my case, I would say, we've grown a lot, and I do think they look at us differently just because of the scale of our business. And so, it wasn't that long ago they said, you have to show you can acquire, you have to integrate, you have to manage your base business, keep your balance sheet strong, all these things. And so we've been able to show that sort of consistent trend. And so when I talk to them now, they tend to look at it and say, okay, we understand your business better, but we also see the scale, and we've managed our leverage within our comfort zone. And so I find they're a bit more receptive. I mean, I can never anticipate where they're going to go, but one would hope that, you know, with scale and size and consistency, they will start to give us a, you know, a positive view. We'll see.
Okay, great. Well, unfortunately, we're out of time, but thank you both very much for joining us today.
Great. Thank you.